All right, let's get started. Today is SilverOak's quarterly webinar. We, as usual, have with us both myself and Jonathan Charlo. So I'm President, Partner, and Chief Compliance Officer of SilverOak. And Jonathan is also one of our partners and lead analyst. In today's webinar, we are going to be discussing the overall markets and economy. In doing so, we'll be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we're not going to be discussing specific SilverOak portfolio performance, given each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized reports within the last few weeks. If you have any specific questions, feel free to talk to your SilverOak advisor if they've not already reached out to you. And Jonathan, I do want to take a minute to thank you and the rest of the team who make the webinar possible. It is a lot of information to gather in a relatively short period of time. And also, as usual, the webinar is scheduled to last 45 minutes to 60 minutes, and a copy will be posted to the website afterwards. If you have any questions throughout the webinar, feel free to contact your SilverOak advisor at the end of the session. And if you're not working with a SilverOak advisor, you can contact me directly at 952-896-5701. And of course, being the Chief Compliance Officer, I have to add the last little disclaimer: past performance is no guarantee of future success. So, Jonathan, what are we going to be looking at today?
Well, today, per usual, we'll be talking about the economy and the SilverOak dashboard. We'll review market performance for the quarter. We'll provide a special update on the tariff situation and kind of the implications. We'll provide our outlook. We'll also talk a little bit about valuable reminders that we think are important based on what we've seen in the last couple of weeks. We'll provide some updates on SilverOak. And as usual, if anyone has any questions at the end, we'll provide our contact information.
All right, so let's start with the economy and specifically the dashboard. So as usual, the dashboard is broken out into 4 major components. The first component is the economy. So you can see here we're showing the quarterly data going back to toward the end of 2021, with the most recent data obviously to the far right. The economy is actually made up of 24 subcomponents or factors. We can see the first quarter was still positive. Green signifies positive, red negative, gray is neutral. And it does look like as we approach the second quarter, we're anticipating that we'll go from quite positive to neutral. As it relates to the credit markets, which that has 7 subcomponents, that one we expect to remain neutral. It has been neutral for the last couple of quarters. Valuations are negative. Now, I was a little bit surprised here, Jonathan, when I saw valuations are projected to remain negative. Of course, we didn't have really the big pullback in the markets until after the quarter ended as the tariff rhetoric increased. But I want to remind everybody, even in the second quarter, as we're projecting, they're negative. And that's because this dashboard that we're looking at least on this page, is using quarterly rolling numbers. And the pullback that we had, it's been relatively short-lived. We'll look at some of those numbers here in a few minutes. Certainly it was deep, but very short. So unless that continues, it's really not going to factor into these quarterly rolling numbers for a while. And then, of course, the next component of the 4 components is market sentiment. And that has been positive until recently, but again, you're going to see on the next dashboard that uses monthly rolling, that that monthly data is starting to capture more quickly than this quarterly rolling data. So overall, the composite has been neutral and will, at least we expect, remain neutral as we look into the second quarter as well. But here's where we have the dashboard that's using monthly rolling data. And if you look at the top right, you'll see the 6-month average is 3.3. And looking at it on the chart, that puts us pretty much right in the middle of neutral, which corresponds to the quarterly data that we saw before. But the current at 2.7 brings us down into that more negative category. So it does look like, as we start looking at the shorter term data, it's definitely drifting in the wrong direction. So with that, let's look at a couple of the subcomponents. And we're going to start off with the economy. So with the economy, what I'd like to do is, there's just been so much movement since the end of the quarter. Jonathan, I think what I'd like to do is just like big picture, and as we think about manufacturing, I'd say for the quarter, it's kind of a push. Some items were slightly benefiting, some were maybe slightly negative, but mostly a push. But the monthly is flat to maybe more so declining.
Yeah, and in addition, what I would say is when you look at the ISM manufacturing and non-manufacturing indices, this is sentiment or soft data. And we're going to see that the soft data in many areas is weakening based on sentiment around uncertainty in the tariffs. When we look at the hard data, which is perhaps lagging a little bit, we're still seeing very solid numbers. So the question will be going forward with the economy, will the hard data kind of come down to where we're seeing the soft data?
Got it. And that kind of gets us into this next slide around unemployment.
Yeah, this is more hard data, and while unemployment has ticked up a little bit, the labor markets have been relatively strong in this environment.
What about housing?
Housing it starts, what we're seeing, most recent data, has ticked up a little bit. But there are other things that are out there within housing. And so one of the things we have to also think about is what's going on in existing home sales. And that data has definitely been weak this spring.
Yeah, I mean, the existing home sales that came out yesterday were pretty terrible. I think down almost 6% since from February into March. I think on an annualized basis, the worst in like the last 12 months.
I would say is when we look at the hard data, certainly housing has been affected. And I think it's obviously because of high interest rates.
How about credit markets?
Credit markets, again, really have not changed much. They were inverted, and really about a quarter ago, they became uninverted, meaning we have a slightly positive yield curve.
And even spreads, although they ticked up, they really have not ticked up all that much.
Yeah, in the past couple of webinars, we had a question mark because they kept on coming down when we thought maybe they would flatten. What we did see this quarter is we did see them tick up a little bit.
And the concern here is when they tick up a lot, when they kind of explode like we saw in 2008, that indicates a lot of fear in the market. Now, a bright spot has been in this next slide on corporate earnings.
Yes, and this year are projected to increase. And what we've seen so far for the year is that maybe the original estimates have come down a little bit, but they still are positive. And we're so far, I mean, again, we're early in the earnings season. They've been generally pretty good. Now, areas where we've seen, weakness in the past, that I think that's continued, but we've seen some areas where definitely things are looking pretty good.
And then market sentiment, which that really has dropped.
Oh, absolutely. And really, actually, again, more so even after the quarter. Now, this data is actually through the 17th, so it incorporates the weakness we saw relative to the tariffs. But the concerning part of it is that the 50-day moving average has crossed through the 200-day moving average. So from a market technical perspective, now this is probably in the weeds a little bit for many people, that is typically a negative signal on the market.
All right, so overall quarter was decent, but since the quarter ends, I would say generally kind of flat to maybe negative on the overall sentiment and composite. As far as performance goes, though, the quarter for U.S. markets was kind of rough. International markets actually had a pretty good quarter. 1 year, pretty much across the board, other than U.S. small caps, as you can see, had positive performance. So still looking back on a rolling basis, not terrible. Now, we've got updated information because we realize some of this has changed, but believe it or not, year to date, as of last night's market close, these numbers aren't too far off on a year to date basis from where we ended the quarter. And of course, here's the bonds. And to a lot of people's surprise, because we're hearing a lot about the bond market, bonds end the quarter overall positive. And you'll see even as of last night, their year-to-date numbers, although maybe not quite as good, they're still positive. Okay, so what led equities during the quarter?
It was clearly a value quarter. And we saw that across large cap stocks, mid cap stocks, as well as small cap stocks.
Meaning growth did not perform as well. So if we look here at the breakout of the sectors, the reason for that?
Well, we can start on the bottom and look at consumer discretionary and technology. Those were down double digits. Obviously, there's been a concern about the economy, and those were stocks that actually have done very well over the last couple of years. And on the other side of that, we saw actually pretty good performance in financials, energies, consumer staples, and utilities.
Got it. So when we think about growth and we think about consumer discretionary or technology, I think a lot of people might think about Mag 7.
Yeah, and this is a term that didn't really exist 2 years ago, but it has been for the last couple of years a very big driver in the market. And so last year, we saw a lot of strength in these 7 stocks, but actually this year, that's completely reversed, and that's actually where we're seeing more of the weakness. And so for the quarter, they were down, whereas if you took them out, the S&P was actually flat to up a little bit.
Interesting. And finally, Jonathan, international provided the diversification benefit that we have been hoping for. Pretty much across most of these categories that we see. That's a welcome shift.
Absolutely. It helped diversified portfolios in the quarter.
Definitely. And the decline in interest rates for the quarter, although this is maybe, of all the slides that we've looked at, this is probably one where we've seen maybe a shift since the end of the quarter. But at least for the quarter, the lowering of rates did help with bond performance.
The one area where we did not see that was in the municipal market. Now that is more of a technical issue. In the first quarter, this is a retail-led investor group. We saw a lot of issuances early on. And so the reason why we actually saw kind of flat to down performance was that the yield curve for municipals actually looked very different than the other fixed income sectors. We saw the 10-year and 30-year portion of the yield curve, they were weak, meaning yields went up, creating headwinds for municipal
So when
bonds.
yields go up, bond prices go
Go
down.
down.
Exactly.
Yeah.
Yeah. Well, and to your point, the first quarter of the year, maybe the first 4 months, always tend to be a little bit rough on munis anyway, because as you pointed out, a lot of issuance. So there's a lot of bonds and there's not a lot of buyers. Typically portfolios get rebalanced at the end of the year, and a lot of owners of municipals are individuals and they sell to pay taxes. Exactly.
Yep. And the interesting thing is that we have seen an increase in some municipal mutual funds. And so in that selling pressure that we saw, people were selling out of the funds, again, to raise taxes,
Yep.
is what we think happened.
Yep. Well, I did mention we would look at up-to-date performance data. So here we're seeing performance data literally through last night. And if you compared these numbers to the quarter end, as I made reference to, you're going to see they're not that far off. US is down a little bit more than it ended the quarter. International's up a little bit more than it ended the quarter. And I will point out as well, a lot of that international performance is currency. You know, that 0.9% positive is not factoring in the currency. The 7 is. So, you know, what had been a headwind is now a tailwind for those international positions. And then, of course, here we have the max drawdown. So, you know, as people were getting nervous, we were starting to see a bear territory, certainly bear territory in small caps. I think there was a lot of anxiety, but, you know, really performance came back pretty strong. And, you know, if you put in at the low, you'd be looking, you can't, nobody can time those. But the point being, selling was the wrong. Okay. And we see the same numbers here for the various bonds. So you'll see bonds are still up. I made reference to that as well. Not up quite as much, at least the US bonds are not up quite as much. I think global bonds are up even more. A lot of that has to do, again, with that currency conversion. And then we have commodities and REITs kind of there at the bottom. One item I'd like to touch on, Jonathan, though, is we did have a question. We had a couple questions come in before today's session, and one of them was around gold specifically. So we can see commodities were up, but that's a broad basket of commodities. If you look at gold, because it's obviously in the news, it's hitting literally all-time highs. It was up more than 20% year to date, even more if we go back a little further. And I think the question was, you know, what do we think about gold? Are we suggesting that people now buy gold? And I guess, you know, just thinking about it, Jonathan, you know, a lot of people look or view gold as an inflation hedge, or I guess historically they've done that. It's really not as much an inflation hedge. It's maybe somewhat, what do you say, a currency hedge against the dollar. Dollar's been weak this year, gold's been strong. But I think it's probably more so a hedge against uncertainty. When it looks like the world's imploding, people still, for whatever reason, gravitate toward an asset that pays no dividends. Very hard to hold, but it's been around forever, and that's gold. So what would you say with regards to the perspective of buying now or adding to a portfolio?
Well, again, as you hit, you really don't get a dividend, you don't get a yield. The only way you can make money in gold is if you're able to sell it for a price higher than you purchased it. And when we look back historically, say over the last 10, 15, 20 years with gold prices, in the past, when gold had a big run, it tended to reverse. And if one had bought gold back in 2011 and 12, it would have taken almost 8 years to get back to that original price. Now, I don't think that's necessarily going to happen. We don't know. But when we see gold spike, typically that is a bad time to add once it's already up.
Yeah, yeah. And then we also had a question that was with regards to if both equities, or I guess the question specifically was, with both equities and treasuries suffering, are you suggesting any changes to portfolios, presumably? The way I would address this is, as we look at these data points, bonds generally, like broad-based basket of bonds, are actually up. So it is true, U.S. equities are down, but bonds generally are still positive. International equities are still positive. So I would say we're definitely not abandoning the diversification approach. Although I understand when you look at treasuries have had some pressure. There's no doubt about that. And I think that's part of the reason why the president has kind of shifted off of his hard stance on tariffs, because he saw what was happening in the treasury markets. But we're not investing per se in treasuries. We're investing in municipals where it makes sense. Otherwise, we're investing in a broad basket of taxable bonds for the majority of our clients. Anything you'd like to add to that?
I think that's a great synopsis. Yes, treasuries have had their issues in the last couple of weeks, but again, the general bond market has not seen the same level of stress.
Yeah. So thank you for those two questions for the individuals that sent those in, and I encourage future questions. As far as our update, of course, we've been talking already about tariffs. I'm not going to go into detail because frankly, what's happening with tariffs could literally change by the time we are ending this webinar. But the general direction is undoubtedly tariffs are going up, and it's going to have some impact.
Now we're showing it here. We don't know, because again, this was actually done before the reciprocal tariff announcements.
That's a fair point.
They're on pause, but again, we don't know.
Yeah. And so I'm going to skip through this one pretty quickly. What we do know is tariffs are leading to uncertainty and increased volatility. Okay, and we can see that here with whether it's the stock market volatility measure or the economic policy uncertainty measure, both have spiked. Now, I will also kind of put this in terms of relativity. They have spiked, but not to levels that we've never seen before. With that increase in volatility around economic uncertainty in the markets, we've certainly seen volatility increase here as well, Jonathan.
Absolutely. So in the fourth quarter of last year, the dollar spiked higher, which hurt international equity performance. And then in the first quarter, it came right back down. And since then, it's even gone a little bit lower. And so we've seen that in the international equity returns where that's provided a tailwind.
Yeah, so weaker dollar, international for US investors anyway, does better. And this is a great point to take a brief second and address another question, a third question that we'd received. And the question was regarding concern on what would happen if the US dollar no longer served as the worldwide exchange currency for financial transactions. And then the question went on to ask what will happen to treasuries and the bond market. And I presume then by extension to investors' portfolios. So there's a couple of ways to address this. I guess the one thing that I would want to do is just kind of step back and have a discussion around the US dollar, because it's weakened for sure, and there's a lot of uncertainty in the world. But I think the assumption that overnight or even over the short-term foreseeable future, the dollar would no longer be the currency of exchange worldwide is just hard to believe. I mean, because if that were to happen, you have to have a replacement. And no matter how your view is on the US, on the dollar, on what's happening, there just currently is not a replacement even close to second of the US dollar.
And I would add that this isn't the first time we've heard this.
Yes.
We heard this in the mid 2000 when the euro was really strong. There was that thought that maybe the euro would replace the dollar. That never actually went anywhere. And then about 10 years ago, there was the thought that a couple countries, Russia, China, tried to come together with a basket of securities and do more and more energy transactions. Now, it's not to say they're not doing some, but that certainly isn't a majority. And there's really no call to take commodities off of kind of being priced in the US dollar.
Right, right. I mean, if it did happen, let's say, this shift did happen, particularly over any shorter period of time, I mean, it would be a massive shift in markets, and would probably cause rates to spike, bond prices to plummet. But remember, that's not just hurting us, but that's hurting a lot of our friends and allies worldwide. Japan holds huge amount. I think they're the #1 holder of US Treasuries.
Mm-hmm.
So, if rates skyrocket and prices plummet, now they're writing down everything on their books. China would have to write down all of their treasury. I mean, the Eurozone's got a ton of US Treasuries. So it would certainly be negative, but it's not something that we're shifting our strategy around, because the likelihood of it occurring is just so remote until there's an alternative available in the marketplace. Now, that doesn't mean that, I don't know, you pick the 50 years, 100 years, whatever it is, that there's not going to be an alternative. I mean,
it's possible. I mean, because 100 years ago, the reserve currency was the pound sterling.
Exactly.
So we know it happens over time, but right now there's just nothing on the near-term horizon.
Yeah. But again, thank you for the question. Hope we were able to address that. Let's talk about inflation, because it looks like, at least from the chart on the right, that consumers' expectations are increasing significantly.
Yeah, and that is important. If people's expectations were really to anchor around that could make inflation stickier going forward. And that's something that the Federal Reserve does track.
But that's coming off of inflation generally. I mean, I know it really spiked around COVID, but generally has been decreasing overall. I mean, it's a little stickier, but has generally been decreasing.
Yeah, we've seen housing and some service inflation being a little bit stickier. On the left, you can see that that's come down a little bit. But if you really look at the blue line on the left, that's really come down quite a bit from where it was when supply chains were disrupted. So if we look on the right, that spike that we've seen recently, I think that's where some of the concern is coming from with tariffs, reciprocal tariffs. If we get into a trade war across the globe, we could see these prices really go up.
Yeah, and you mentioned supply chain, so that could come into a factor of pushing inflation back up. So I really think, right now you mentioned soft versus hard data. We're starting to see the soft data kind of shift more negative. Haven't yet seen the hard data shift more negative yet. But, there's no question that what's occurred here over the last few weeks, particularly around tariffs, it is causing uncertainty, and that could discourage business investment, which would be negative. It could have a potential impact on GDP, really worldwide. I mean, we're not just talking about the US, but across, the globe. And it's also, frankly, increasing the odds of a recession. We'll see in a few minutes, our base case is still not a recession, but that's getting reevaluated literally daily. So what has occurred, at least in the short term, has not been positive on all of this information. Which brings me to what is our outlook, both from an economy perspective and a markets perspective.
Well, we're kind of looking through tariffs, and again, this could change on a daily basis, but they, in general, they threaten economic growth, and it could deteriorate consumer and business confidence further, which then would cause the soft data that we're seeing weakening actually cause hard data, the actual economic numbers to come in, and we are seeing them cause inflationary concerns. As you mentioned, a recession is not our base case, but those risks are rising. And the longer we have this uncertainty could lead the sentiment indicators to get worse, could cause businesses to really shift their decision making until after this is done, which would have an impact on the recession odds. And unlike, say, during COVID, where the Fed basically came to the rescue, the Fed, because of the current situation, will likely start to lower rates at some point, but because of the situation we're in, they're not going to be able to aggressively lower rates.
Because we have to remember the Fed has a dual mandate, right? To make sure we have stable prices, i.e. not inflation, and full employment. And right now, the employment numbers, as we referenced earlier, they look pretty good. But the concern is on the inflation and with the tariffs maybe causing more inflation or at least being stickier. So probably not until maybe employment data got a lot worse would they.
Right, and we didn't talk about this prior, but one of the things that they're probably also looking at is what is going to be in the tax bill.
Yes.
Because that could also, if there are massive tax cuts,
yes,
could be add to the inflation pressures.
Yeah, and we're going to talk about that on the next slide.
Yep.
As far as international economies?
Yeah, there will be an impact globally if there's a trade war. Now, the other thing, though, we are seeing is other central banks have started to lower rates. So they're a little bit ahead of the Fed in that sense.
So what do we think with regards to the markets and the impact that this is going to have on the markets? And I don't know, this might be far-fetched, but I think people should expect continued volatility.
Yeah.
I don't know how far-fetched that is.
The market uncertainty index, or the VIX, that has been much higher this year than it was last year.
Yeah. And certainly should recession risk materialize, I wouldn't be surprised if we don't have a more pronounced market pullback. So I'm not so sure it will be a long pullback, but steeper market declines typically come with recessions. However, having said that, you made reference to the tax policy.
Yeah, that is coming up. So that would be probably perceived by the markets as a bit more positive. Now, again, depending on the magnitude of them, it could then stoke inflation fears a little bit more. But if we're talking about some of the corporate tax cut, lower or no taxes on overtime, tips, of those things of those nature, I think the assumption is that money would be spent.
Yeah.
It would go immediately into the economy, and that's where that inflation fear could come from. That, but it certainly would help the economy.
Right, and then also the administration. I always think they have kind of three massive agenda items: trade, i.e. tariffs, taxes you made reference to, and then regulations. And regardless of your political perspective on those three items, it would be perceived that tariffs or the trade would be the negative impact of the economy and the markets for that matter. And taxes and regulations, if they can pivot to those, might be more market friendly. Corporate earnings, we already touched on this. They still look pretty good. I mean, we just got some corporate earnings today. They look good. We're at the beginning of earnings season this quarter. And so far, there's not been a lot of surprises on the downside. If anything, probably neutral to surprises on the upside. So that could help re-anchor confidence, especially if we could get these darn tariff discussions out of the way and get some deals done. That could be quite encouraging. Small caps, they definitely continue to be challenged. We saw that in the performance numbers. U.S. small caps are the worst performing sector, though as things have kind of shifted, they may be one of the more cheap part of the markets as well. In international, well, that continued diversification is likely probably going to continue to add value.
Yeah, and a lot of that I think will certainly be influenced by the direction of the U.S. dollar.
Yes, yeah. Well, and to the point of international, why don't you touch on Europe?
Yeah, so one of the things we showed on the up-to-date year-to-date numbers was that Europe international actually strengthened from where we were at quarter end, and that is just clearly Europe has been a lot of that, and we've seen that those stock prices have actually fully recovered from where they were starting on April 3rd when the markets declined, whereas the US, we've seen a good bit of that recovery, but not a full recovery.
And what about the fixed income market? So we just went through our outlook on equities. Where do we think bonds are going to go?
We think that they'll continue to provide stability for the balance of the year. So the base case for bond returns really in this environment would be the yield that they provide. We could, again, see some volatility around interest rates, but again, we're starting in kind of a 4 to 5% yield range. We have policy uncertainty, so certainly we'll see some interest rate volatility. The recent rate spike we saw a couple weeks ago, which did, I think, lead Trump to come out and put on pause the reciprocal tariffs, might have been a bit more technical in nature. I know some people have been worried about, does that mean that China is selling their treasuries? But it looks like, you know, there was a lot of leverage in the system, and certainly the big declines in the prior week potentially caused margin calls. And so people were selling bonds as a result. We've also touched on Fed cuts likely later this year, but again, they would probably need to see the hard data weaken a bit. But the Fed has also hinted, short of cutting rates, there are many other things that they can do to provide stability to the bond markets in the interim. We think that municipal bonds are still attractive despite their recent performance trends. Historically, they're at very attractive taxable equivalent yields. And then when you actually look at the fundamentals of states and the municipalities, they are flush with their rainy day funds, and debt as a percentage of the overall economy is at low levels. We're just not seeing that many big projects and big bonds being floated.
Excellent. Well, thank you for that. So after having gone through kind of our outlook, let's talk about a couple valuable reminders, because I think the last couple of weeks have been very informative. First of all, and I know we've talked about most of these concepts, but it's been a while, but volatility is like a magnet. It bunches together. So you'll see some of the best, worst days in the market are very, very closely aligned to the best days in the market. So the worst days and the best days come together in close proximity to each other. And this has been the case for years and years and years. And this chart is just making a point of that. Also, Jonathan, it seems like in my career, there's almost always a reason to sell. Like there's always a reason why people think the market's going to go down and this time is different.
Mm-hmm.
And hey, don't get me wrong. I know there's a lot of uncertainty and I know each time does feel a little bit different. But the one thing we know of the market long term is that it likes to go up. I explain the market, and I've mentioned this probably in a past webinar, like a fishing bobber, which seems a little silly and maybe simplistic, but when you think of the fishing bobber, you've got a fish on the line. There's this temporary force pulling that bobber down below the surface of the water. But when that force releases, the bobber, its natural state is to pop right back up. And the market is much like that fishing bobber. Its natural state is to pop back up and to try and time these things. Even what we saw the last couple of weeks where we were down almost 20% across all of these equity markets in the US. And just a week or two later, we've gained back half of that. I mean, that's
Absolutely.
amazing.
You look at 2020, you look at 2022,
Yes.
which
Yeah.
really aren't that
Yeah,
long
the Great
ago.
Recession, 2008 versus
Yep.
2009. I mean, we just see it time and time again. So that does then bode to the benefit of a steady strategy, not trying to time this or to shift, from one particular strategy to another strategy to try and like get the best diet fad of the month or the quarter.
Yeah, and so here what we're showing are in orange those down years, period returns versus the next 12 months. And so it goes from Black Friday all the way to the most recent inflation shock in 2022. And what you see is when you have negative returns like this, getting back to that bobber analogy, it wants to come back.
And we see this here too, where we see pullbacks, maybe following, pullbacks of 10% or more. They're followed by, again, big positive returns.
Yeah, and what I'd also add when we look on the left to those returns following a 10% market decline, there have been 9 of those in the last 20 years, and 7 of the 9 we saw positive returns in the next 12 months. The reason we didn't in those other 2 was because those 10% returns actually turned into something more. And so that data actually goes to the right side.
Yep. Got it. Yeah, and of course there's no guarantee on any of these, but this is history. This is what we continue to see time and time again. And this one is, I just absolutely love this. It basically is trying to point out that when bearish sentiment is the highest, so people feel the worst, sentiment data is coming in terrible, that the average returns thereafter, particularly 1 year thereafter, are really strong. And we see that on this chart, which we've shown this chart a time or two before as well. This is showing, like at the bottom, the line is the consumer sentiment. So when consumer sentiment is really, really low, you'll see then I don't know what color that is. Is that blue or purple?
Light
Okay,
blue.
light blue. Sorry, I'm colorblind. The light blue, that's the performance for the market the following 12 months. So, I mean, you can almost look at every point where consumer sentiment has hit the worst, and the next 12 months is great. Or when consumer sentiment's really high, the next 12 months doesn't tend to be all that good. And as we said earlier, sentiment has been dropping like a rock.
Mm-hmm.
And of course, here we're showing just that, market downturns, like you just got to accept them. They don't happen that often, and they're usually not that severe relative to the rest of history.
Yeah. Now they do feel severe when you're in it.
Fair point.
But when you can see just the historical evidence of what the recoveries look like afterwards, and that's the black portion of this, the the pain is worth the gain that you get.
Yes,
so to
yeah,
speak.
that's a fair point. And then, of course, here, we're just pointing out the benefit of diversification, which is really key to hedging against uncertainty. We talked throughout this session about uncertainty, particularly once we started into the discussion around tariff and the uncertainty that that's provided. To know which of these sectors is going to outperform going forward is literally impossible. So that's why I love this quilt chart. You know, columnar is each year. So in each column, there's a different year, going all the way back to 2006 to most recent year to date on the right. And then each type of investment or sector is color coded. Now I hate this because I'm colorblind, so I have a really hard time looking at it. But you can see, regardless, that like not one sector or type of investment is always the top or always the bottom. These things are shifting constantly.
And one thing we've seen year to date is that there has been a shift. So what was leading last year, meaning large cap growth stocks, are not leading this year.
Yes, yeah, fair point. Very good point. So let's go through a couple of the SilverOak updates as we close out today's session. First, Jonathan, could you give us just a brief overview of our IQs, which is our investment quality scoring system?
Yeah, overall, I'd say mid-cap was a challenging part of the market, both on an absolute relative basis. When we look at large cap and small cap, I'd say those were kind of overall neutral. Now, of course, on an absolute basis, small caps were down more than large caps.
But our positions were more neutral with what we were seeing in the markets.
Yeah. But on a positive side, certainly international and taxable bonds provided better absolute returns, and actually our investments on a relative basis did add a very nice positive contribution. Munis, as we mentioned, have been kind of challenged this year, and what I would say in general with our investments is that they've been kind of neutral to that.
Sure. Yeah. Okay. Other updates? Well, 2024 tax season's over. Gotta love that. Although we did extend for various reasons, usually because K1s are missing. We did have some extensions that we're still working on. We are expanding our workstations and looking at other office space considerations to accommodate a growing team. So that's always good to see. And we've got a lot of summer projects, including the implementation of some new internal systems, including the possible use of some new AI tools that we're excited to roll out. And then even more exciting, Jonathan, is we have a number of team members who have announced or have recently had babies. So the SilverOak family, or at least extended family, is continuing to expand. So it's super exciting to see. Of course, not you and I.
Well, if it's in
the younger
water,
folks.
if it's in the water, I'm drinking bottled water.
There you go. Exactly. Exactly. That would have to be a miracle in my instance. With that, we would like to thank everybody for taking the time today. If you have any additional questions, or if you want to suggest any topics, reach out to your SilverOak advisor. Or if you're not working with a SilverOak advisor, feel free to reach out to me directly. I'm at 952-896-5701. Otherwise, again, thank you for your time, and have a wonderful day.